Hey, everybody, and welcome to another episode of the Dan Habib Show. I'm Dan Habib, your host. We have an action packed show to go over with you today, but a few reminders first. If you're in the mortgage and real estate space, if you want to get content like this on a daily basis, make sure to go to mbshighway.com. Check us out. You can sign up for a 2-week trial. And if you want to be the most educated crypto investor you can be, check us out at cryptocharge.com. If you sign up today and you use the code Habib, you will get a 40% discount. Now, getting into the meat and content of this show, boy, we have seen a lot of action, especially in the bond markets, and this has to do with the UK. So let me break this down for you. So the UK, like much of the globe, has a very big inflation problem. The United States, the last reading on the all-in inflation number, 8.3%. Well, the UK, they're at 10%. So here in the US, what have we been doing to try to reduce inflation? Well, we've been hiking rates. That's the Fed funds rate, and we've hiked it up to 3.25% currently. We've also been reducing our balance sheet from all of our quantitative easing. What that means is asset purchases of bonds and treasuries. Well, the UK, they were planning on reducing that balance sheet by selling their 10-year yield equivalent. Instead of the 10-year treasury, it's called the 10-year gilt. They were planning on selling these next week. They've also been hiking rates, but they're way behind the 8 ball. Their equivalent of their Fed funds rate is only at 2.25%, so 1% beneath ours. However, here's what has transpired recently. The UK, their administration announced that they're going to have a new mini budget, and included in this is all of these unfunded tax cuts. Now, this has caused the IMF to come out and issue some big warnings saying you should not do this. And even Moody's came out and said, if you do this, we are going to lower your credit rating on your bonds. Now, what has this caused? You may have seen this happen in the markets where their pound has gone basically dramatically lower, especially considering you compare that to the dollar. Boy, they're almost at parity. And if you take a look at their 10-year gilts, their 10-year treasuries, right, that has gone up at the most precipitous pace ever over the last few weeks, and it's now at a 15-year high. So what has the UK come out and said? Basically, what they said is this: starting today, we are going to begin buying again. We're going to begin quantitative easing, even in the face of all of this inflation problems they have and the fact that they want to tighten their economic policy. And they said, starting today, we're going to be buying the gilts, the 10-year treasuries in their economy there at an unprecedented pace in order to stabilize the economy. Now, they have said that this is going to be temporary, and they plan on still October 31st starting to sell them and continuing to hike their Fed funds rate there. So think about how crazy this is, right? So it's almost like somebody that, let's say you have an overweight individual and they plan on next month going on a diet and starting to reduce their caloric intake. But beforehand, now until then, they are going to go ahead and eat as much cake as possible. This is essentially what the UK is doing. The UK is buying and sprinkling some more quantitative easing before they plan on doing quantitative tightening. Now, they're doing this to stabilize their dollar or their pound and to stabilize their bond market, but it just doesn't make a lot of sense, and I believe it's going to get them more in the hole. However, how is this impacting us here in the U.S.? Why is this important? Well, if you think about the global economies, they are interconnected, especially when you take a look at the bond market. If you take a look at their 10-year equivalent, the 10-year gilt that they have, that dropped by 50 basis points today, and that is having a big impact on our bond market. And this is welcome news because here you've seen the 10-year touch 4% yesterday. Well, now the 10-year is down almost 30 basis points. It's at 369. Mortgage-backed securities up 100 basis points. This is going to have a big impact on showing some relief on mortgage rates here, which again is welcome news. Now, this week, we'll be back at the end of the week, by the way, with some important inflation data and GDP data, but wanted to bring this halfway through the week edition to you because we did get some important housing news, and I'm going to share my screen here to show you some of the results. So we did get new home sales. Now, new home sales measures signed contracts on new homes. So pretty much people out there signing the dotted line in the month of August. And this number was at an annualized pace of 685,000. Now, from the previous month, up 29%. And if you factor in the fact that in the previous month, there was some upward revisions, if you remove that and looked at the originally reported number, it's up 34%. Now, that means on a year-over-year basis now, sales are actually flat when it's considering the new home sale market from a year ago. Now, listen, you could see pretty big movements because the numbers aren't that big here, but this was a big report. Now, another thing that's important to understand is that there's 461,000 new homes for sale that they count in the inventory. And at the sales pace, that's an 8.1 months supply, right? So that means that if there was no new homes added to inventory at the current sales pace, in 8.1 months, you would deplete all of the inventory out there. Now, this is high because a balanced market is considered 6 months. So some people might look at this and say, oh, the housing market isn't that strong on the new home sale market. However, you have to look deeper than the headline numbers. The amount of homes that are actually move-in ready, the amount of completed homes out there, it's only 49,000. And if you take that into the monthly sales pace, guess what? The month supply is only 0.86 months. So a very, very hot market. This was a very strong report on the new home sales front. And if you take a look at the median home price, it's at $436,800, which has been moderating a bit, down 6.3% month over month. It's still up 8% year over year. But listen, don't get confused. This does not mean home values. The median price is simply the middle priced home. That means half the homes sold above it, half the homes sold beneath it. But that can be influenced by the mix of sales, meaning it appears to me that there was some more entry-level homes available for sale that people jumped on, and the existing home market inventory is very tight. Not a lot of other options because people with rising rates, they don't want to sell their home to move into a new home and go from a 3% rate to now a 6.5% or 6.75% rate, right? So this is something that is important to understand, but the new home sale market showing some resilience. Now, let's jump into home prices because this is surely going to capture the headlines. Case-Shiller is the best appreciation report that we have out there. And this came out for the month of July. So remember, this is lagging by 2 months. But the national index showed that home values decreased in total for the month by 0.3%. Now, listen, on a year-over-year basis, it's still up at a very strong, almost 16%. Now, that's declined from 18% in the June reading. However, still 15.8, 16% is still very strong, but a lot of people focusing on the fact that home values nationwide, if you take them all together, decreased by 0.3%. It's very slow, very little bit of a decline, but still the first time we've seen a decline in this report as opposed to monthly gains. But you have to break it down. If you take a look, a majority of the decline, almost all of it, could be attributed to a few very large cities. And these cities also happen to be the same cities that saw some of the biggest explosions in appreciation. And if you take a look at San Francisco, down in the month of July alone, 3.5%. Seattle, down 3.1%. San Diego, 2.5%. LA, 1.6%. And Denver, down 1.4%. You know what's interesting? If you remove some of these other markets, guess what? Some of them in southern Florida still going up by 1% a month. If you look at Tampa, Miami up 1.2%. As a whole, though, you are not seeing, as a whole, I should say, you are seeing declines, but it's weighed down by some of these big cities. If you remove them, most markets are not seeing declines. They're seeing much more modest rates of appreciation. It's important to note, team, I believe you're going to see vacillations over the next several months, but I think when rates start to abate towards the end of the year, beginning of next year, you're going to see opportunity in the housing market. And I think over the next 12 months, you're going to see modest levels of appreciation nationwide, not depreciation, not home values declining. And that's a very important difference to remember.